As a sign of slowing inflation in October prompted speculation that the Federal Reserve would become less aggressive with interest rate hikes, the S&P 500 and Nasdaq jumped on Thursday, hitting their biggest daily percentage gains in over 2 years. The S&P 500 climbed 5.54% to end the session at 3,956 points. The Nasdaq gained 7.35% to 11,114 points, while Dow Jones Industrial Average rose 3.7% to 33,715 points. October's Consumer Price Index rose just 0.4% for the month and 7.7% from a year ago, its lowest annual increase since January and a slowdown from the 8.2% annual pace in the prior month. Economists were expecting increases of 0.6% and 7.9%, according to Dow Jones. Excluding volatile food and energy costs, so-called core CPI increased 0.3% for the month and 6.3% on an annual basis, also less than expected. Since the inflation is slowing down, is now a good time to invest? Let's first look at the data. From the figure, we can see the analysis of key aggregate components of CPI. The month-over-month percent change for the October is shown in the first column. The second column contains the month-over-month percent change in the prior month. The third column contains the MOM acceleration. This is the difference between the percent change in October minus the percent change in September. The fourth column contains the cumulative contribution to the percent month-over-month change of CPI. This describes exactly how much each component contributed to the cumulative all items month-over-month percent change in CPI. The sum of the values in this column will yield the month-over-month percent change of all items CPI. Finally, the cumulative contribution to month-over-month acceleration of all items CPI is located in the rightmost column. The sum of the contributions in this column adds up to the MOM acceleration of all items CPI. As we can see from here, core services except housing and core goods decelerated very significantly, accounting for most of the overall deceleration in CPI. Others, however, barely slowed down at all, and even energy surged in October. In the following part, we undertake the same contribution analysis as above, but at a finer level of detail. This figure shows top 10 CPI components that contributed negatively and positively to the month-over-month percent change in all items CPI. These contributions take into account both the magnitude of the month-over-month change in each component as well as the weight of each component in all items CPI. One thing that emerges from this analysis is that a significant share of the deceleration of core CPI this month came from relatively volatile items that might be considered one-offs. For example, the significant decline in new and used car prices and health insurance may not be representative of core inflationary dynamics. These items commonly easily affected by other factors such as seasonal adjustment and will have bigger price differences between each month. The graph shows year-over-year change of the CPI for commodities and services. The blue line shows the CPI for goods, and the red line shows the CPI for services. While services continue to grow, CPI commodity growth is beginning to slow down. The question is whether the rise in CPI services will balance out any decline in CPI commodities. If so, the CPI will continue to be lower than forecast for the upcoming few months. However, if the decline in the CPI for commodities is insufficient to offset the rise in the CPI for services, then the CPI is probably greater than expected. This is something we cannot forecast since there are too many unknowns. All we can do is alter our portfolio based on the data. If we look at it from the standpoint of month-over-month change, the pattern is the same as well. While the price of services is continuously rising, the price of commodities is showing a downward trend. Services continued to increase and made the biggest contribution to the most recent CPI. We can see that over the past few months, housing costs have continued to rise. Housing is the most significant expense in a household's budget, making up 43.2% of all expenses. However, there is some good news as well. The CPI data typically has a delay when compared to real-time data. In fact, the U.S. national rent is slowing down. As a result, in the coming months, the number of shelters in CPI may decline. The CPI in October appears to be slowing down overall. However, there are still some concerns, particularly in the services sector. These sectors are still continue increasing and normally will sticky than other sectors. According to historical data, the inflation rate in July is lower than expected, but the inflation rate in August is greater than expected. This implies that, while the CPI in October is slowing, there is still a chance that the CPI may rebound in the next months. Therefore, now is still not the time to risk off. The market sentiment has been overly negative in recent months, resulting in a market rebound when good news such as low CPI finally arrived. Personally, I believe that investors with a high risk tolerance can invest now, but there is a risk that the CPI will be higher than forecast, causing the market to crash. Investors with a low risk tolerance, however, can hold out for a few months until the inflation actually shows a downward trend. Although, when the time comes, the market may rise significantly from its low point, there is still significant potential for future growth. If you have other opinions, let's comment below. Please help to like and subscribe.